If this continues, you won't lose your job overnight. You won't see tanks rolling down your street or breaking news alerts declaring war. You'll lose something far worse, something most people don't even realize they have until it's gone. You'll lose choice. Think about the last time you bought something online. Maybe it was yesterday. Maybe it was an hour ago. You probably had dozens of options, different brands, different prices, different features. That feeling of choice, that ability to compare and decide, that's what's disappearing. Not today, not tomorrow, but it's going, systematically and irreversibly. And by the time you notice it's happening, by the time you walk into a store or open an app and realize there's really only one viable option left, it will already be permanent. That package sitting on your doorstep right now, the one that took 2 days to arrive and cost less than you expected, that's not just convenience. That's the visible surface of a system you don't control, built on infrastructure you don't own, dependent on supply chains that answer to someone else's priorities. And every time you click buy now, you're voting for a future where that someone else has more leverage and you have less. That's America's weakest point. Not its military, which remains the most powerful in the world, not its economy, which is still the largest and most innovative, not even its politics, messy as they are. It's the invisible systems that make everything work. The shipping networks that move products from factories to warehouses to your door. The payment systems that process transactions in milliseconds. The manufacturing ecosystems that turn raw materials into finished goods. The ones nobody thinks about until they stop working. Until the price suddenly jumps and there's no alternative. Until the product you've used for years is simply unavailable and there's no substitute. Until the thing you took for granted becomes a negotiation where you have no leverage. And China has spent the last 20 years, while America was optimized for speed and profit and quarterly earnings reports, learning exactly how to position itself at every critical point in those invisible systems. Not with force, not with threats, not with anything that would trigger alarm or response, with patience, with capital, with a willingness to accept low margins and long timelines in exchange for position. Position that, once established, becomes almost impossible to challenge. Most people are looking at this situation completely wrong. They're watching the news, seeing headlines about tariffs and trade wars, and thinking this is about economics. They see reports about artificial intelligence restrictions and semiconductor export controls and assume this is about technology. Some even think this might eventually lead to military conflict, some dramatic confrontation with tanks and missiles and clear winners and losers. But that's not what's happening at all. Those are just the visible symptoms of something much deeper, much more sophisticated, and frankly, much more dangerous. Because the real game isn't playing out in headlines or legislative chambers or even in corporate boardrooms, though those places matter. The real game is playing out in the unsexy infrastructure of global commerce, in the logistics networks, in the supplier relationships, in the 1,000 small dependencies that nobody notices until they become critical. People think power comes from strength, from having the biggest military or the fastest economy or the most advanced technology. And in the 20th century, they were right. Power came from dramatic displays of capability. Nuclear weapons, aircraft carriers, space programs, things you could point to and measure. But in the 21st century, power comes from something different. It comes from control over systems. Not the exciting systems that make headlines. The boring ones, the ones that move things from point A to point B, the ones that process payments between banks, the ones that track inventory across thousands of warehouses, the ones that coordinate shipments across dozens of countries and hundreds of companies. The ones that most people never see and never think about until they break. And when they do break, when those invisible systems stop working or start working differently, everything else breaks with them. Your convenience breaks, your choices break, your prices break. Your ability to simply decide you want something different and go get it, that breaks too. This isn't about beating America in some dramatic showdown. China doesn't want to defeat America. They want something more subtle and more valuable. They want to make America predictable. They want to understand exactly how American systems work, exactly where the pressure points are, exactly how decisions get made, and exactly how to position themselves so that when those decisions happen, they only go one direction. A direction where China has more leverage tomorrow than it had yesterday. Where American companies, American consumers, American policymakers all make rational, sensible, locally optimal choices that collectively add up to dependency. That's not warfare. That's not even competition in the traditional sense. That's something closer to strategic architecture. Building a system where the path of least resistance leads exactly where you want it to go. To understand what's really happening, you need to see the bigger picture. You need to understand that two completely different games have been playing out over the last 20 years, and most Americans don't even know they're in one of them. American strategy, both corporate and governmental, has been optimized for one thing above all else: speed to profit. Maximize shareholder value, cut costs, increase efficiency, move fast and break things. Every decision, from the factory floor to the C-suite to the halls of Congress, gets filtered through the same basic question: does this make us more money right now? Does it increase quarterly earnings? Does it boost the stock price? Does it create immediate, measurable value? And that strategy worked brilliantly for decades. It created the most dynamic, innovative, wealthy economy in human history. It gave American consumers access to an incredible variety of products at prices that would have seemed impossible 50 years ago. It made American companies the most profitable and most valuable in the world. But it also created something else, something that wasn't visible on any balance sheet or earnings report. It created dependencies, structural vulnerabilities, points of leverage that patient competitors could systematically occupy. Chinese strategy over the same period has been optimized for something completely different. Not profit this quarter, not growth this year. Position. Position in the chain. Position in the network. Position in the infrastructure. Who controls the choke points? Who owns the relationships with the raw material suppliers? Who has the manufacturing capacity that can't be quickly replicated? Who sits between the components and the finished products? Who owns the ports where goods arrive? Who controls the logistics networks that move everything? While America outsourced complexity to focus on high-margin activities, the exciting parts of the value chain where the real money seemed to be, China absorbed that complexity. They didn't just take the manufacturing jobs that American companies wanted to get rid of because labor was cheaper overseas. They took everything that came with those jobs. The relationships with supplier networks that took decades to build. The logistics expertise that you can't learn from a textbook. The institutional knowledge about how to actually make things at scale, how to coordinate thousands of suppliers, how to manage quality across complex production processes, how to solve the million small problems that come up when you're trying to manufacture hundreds of millions of units of something. Think about what that means in practice. Think about the actual structure of how products get made and delivered in the modern world. American companies own the brands. They design the products in California or New York or Seattle. They run the marketing campaigns. They manage the customer relationships. Those are the exciting, high-value parts of the business, the parts that show up in earnings reports and justify high stock prices and generate the kinds of profit margins that shareholders love. But who owns the ports where those products arrive when they come from overseas? Who controls the shipping lines that move them across oceans? Who manufactures the hundreds of components that go inside them? Who processes the rare earth minerals that make those components possible? Who refines the materials that become the batteries? Who controls the factories that do the assembly? At every single one of those layers, at every boring, low-margin, unglamorous step in the process, China systematically positioned itself to be either the only option or the default option. Not by force, not through any kind of coercion, by being willing to accept low margins and long time horizons in exchange for position. And here's the thing that most people miss, the thing that makes this so difficult to counter once it's in place. Control the boring parts of the system, and you eventually control the exciting ones too, because the exciting parts can't function without the boring parts. You can design the most innovative product in the world. You can create a brand that consumers love. You can have the best marketing and the most loyal customers. But if you can't source the materials, manufacture the components, and ship the finished goods, that innovation stays on a whiteboard. That brand doesn't matter. Those loyal customers can't buy a product that doesn't exist. And when one country controls enough of the boring parts, they don't need to control the exciting parts. They just need to set the terms. They just need to have enough leverage that when conflicts arise, when interests diverge, when decisions need to be made about priorities and timing and pricing, those decisions tend to go their way. Not through threats, through simple structural reality. You need them more than they need you, and everyone knows it. That's not an accident. That's strategy. Patient, long-term, systematic strategy that doesn't care about this quarter's earnings or this year's election cycle. Strategy that thinks in decades, not quarters. Strategy that's willing to lose money for years if it means occupying a critical position. Strategy that understands something fundamental about how systems work. The first mover in a high-profit market gets headlines and attention and sometimes spectacular returns. But the patient occupier of critical infrastructure gets leverage. And leverage, over time, tends to be more valuable than profit. Because leverage is what allows you to extract profit later, on your terms, when the people who chased the exciting opportunities suddenly realize they're dependent on systems they don't control. Now, here's where things get uncomfortable. But stay with me, because this is critical to understanding what's actually happening. The danger here isn't dramatic. It's not tanks or missiles or some Hollywood scenario where everything collapses overnight in a shower of sparks and emergency broadcasts. The real danger is far more subtle and far more insidious. A system you don't control doesn't break suddenly. It slowly stops working in your favor. Prices rise, not because of inflation or normal market forces, but because someone somewhere in the chain decided to raise them, and you have no alternative supplier, no backup option, no ability to simply walk away and choose something else. Options disappear, not because they're technically impossible, but because the infrastructure to support them no longer exists. The factories closed 5 years ago. The expertise retired or moved to other industries. The supplier relationships dissolved. And rebuilding all of that would take years and cost billions and require the kind of patient capital and long-term commitment that American markets, optimized for quarterly returns, struggle to provide. Decisions that used to take days start taking months because they require coordination with systems and people and organizations you don't control, and they're not particularly motivated to move at your speed. They have their own priorities, their own timelines, their own interests, and you need them more than they need you, which means your urgency isn't necessarily their urgency. This is dependency, not the kind that shows up in headlines, not the kind that politicians can point to in a speech and say, "We need to fix this right now and expect immediate action." The kind that creeps in gradually, one convenient decision at a time, one rational optimization at a time, one perfectly sensible cost-cutting measure at a time. Until suddenly you realize that reversing course isn't just expensive or difficult or politically complicated. It's practically impossible. The path you've been walking, the one that seemed smart with every single step, has led to a place where turning around would cost more than you're able or willing to pay. And no one can explain exactly why things changed. That's the genius of it. There's no single decision point you can identify and say that's where we went wrong. That's the moment we should have chosen differently. There's no dramatic inflection point where everything shifted. It's 1,000 small choices, each one perfectly rational in isolation, each one defensible on its own terms, that add up to a fundamental loss of leverage. You wake up one day and realize that your economy, your supply chains, your ability to respond quickly to changes in the world, all depend on systems and infrastructure controlled by someone else. Someone whose interests don't always align with yours. Someone who's perfectly happy to keep things running smoothly as long as you stay predictable. As long as you keep making the choices they've structured the system to encourage. Jeff Bezos once said something that applies here in a way he probably never intended when he said it. Your margin is my opportunity. He was talking about business strategy, about how Amazon could undercut competitors by accepting lower profit margins, by being willing to make less money per transaction in exchange for volume and market position. It's one of the core principles that built Amazon into what it is today. But China didn't just apply this principle to companies competing in a market. They applied it to countries competing in a global system. Every time America optimized for margin, for short-term profit, for shareholder value, for quarterly earnings growth, they created an opportunity. An opportunity for someone else to step in and own the parts of the value chain that America didn't want anymore, the parts that weren't profitable enough, the parts that moved too slowly, the parts that required too much patience and capital and long-term commitment, the parts that, 20 years later, turn out to be the parts that actually matter when conflicts arise and interests diverge. American companies made perfectly rational decisions to outsource manufacturing because labor was cheaper overseas, and shareholders rewarded companies that reduced costs and improved margins. American policymakers made perfectly rational decisions to let market forces determine where production happened, because that's how capitalism is supposed to work. That's the system. That's what creates efficiency and innovation and wealth. Each decision made sense individually. Each decision was defensible. Each decision, in isolation, was probably correct, given the information available and the incentives in place. But China wasn't making individual decisions. They were executing a coordinated strategy to position themselves at the critical nodes of the global system. They were patient where America was fast. They were systematic where America was opportunistic. They were long-term focused where America was quarter to quarter. And slowly, gradually, without anyone really noticing until it was too late to easily reverse, the balance shifted. Let me give you a concrete example of how this plays out in practice, because abstract strategy is interesting, but real examples make it visceral. There's a mid-sized American technology company, we'll keep them anonymous, but this is a real story, that made what seemed like a smart decision about 5 years ago. They were spending about $40 million a year on domestic component manufacturing, specialized electronics parts that went into their main product line. It was eating into their margins significantly. They were profitable, but not as profitable as their competitors, and Wall Street analysts kept pointing out the margin gap in every quarterly earnings call. Their shareholders were getting restless, the stock price was stagnant, the board was asking hard questions about why they weren't optimizing their cost structure like everyone else in the industry. So they did what dozens of other companies in their sector had already done. They found a Chinese supplier who could deliver the same components, same specs, same quality standards at about 40% of the cost. They did their due diligence, visited the factories, checked the certifications, ran pilot programs. Everything looked good. Quality was consistent, delivery was reliable, communication was professional. Everything worked perfectly. Over the next 2 years, they gradually transitioned all their component manufacturing overseas. They shut down their domestic facility in Ohio, offered early retirement packages to the senior manufacturing staff, sold the equipment to other companies, or liquidated it. Within 3 years, they had completely exited that part of their business. It didn't make financial sense to maintain it when they had such a reliable, cost-effective supplier relationship overseas. Their margins improved. Their stock price went up. The analysts were happy. The shareholders were happy. The executives got bonuses for the successful cost optimization program. Then, about 18 months ago, something interesting happened. Their Chinese supplier quietly raised prices, not by a huge amount, not enough to eliminate the cost advantage, just enough to hurt. A 12% increase across the board, take it or leave it. The company was surprised but tried to negotiate. The supplier was polite but firm. This is the new price. You can accept it or find another supplier. So the company looked for alternatives. Here's where it got interesting. Turns out most of the other suppliers in that component space were also Chinese, often sharing infrastructure, supply networks, sometimes even partial ownership structures. They all had similar pricing. Some were actually more expensive. The few American companies that used to manufacture those components had shut down years ago, following the same logic, making the same rational decisions, optimizing the same cost structures. Their equipment was sold off or obsolete. Their expertise had retired or moved to other industries. Their facilities had been repurposed or demolished. The company ran the numbers on starting up domestic production again. It would require somewhere between 200 and 300 million in capital investment. It would take 3 to 4 years to fully operationalize. And during that time, they'd still need to buy from their current supplier at the higher price, because stopping production wasn't an option. By the time domestic manufacturing was online, they'd have spent so much and waited so long that they'd be at a massive competitive disadvantage. Several of their competitors would likely have gained significant market share. Their stock price would have cratered. They might not even survive as an independent company. So they accepted the price increase, not because they wanted to, because they didn't really have a choice. The negotiation was over before it started. The leverage was obvious to everyone involved. This story isn't unique. Variations of it are playing out right now across dozens of industries. Pharmaceuticals, where roughly 80% of the active ingredients in American prescription drugs now come from Chinese manufacturers. Solar panels, where the entire supply chain from raw polysilicon to finished panels is dominated by Chinese companies. Consumer electronics, where entire categories of components are available from essentially one geographic source. And here's the crucial part that makes it so hard to fix. It didn't feel like surrender. At every step, it felt like efficiency. It felt like smart business. It felt like exactly what companies are supposed to do in a competitive market. Optimize costs, improve margins, focus on core competencies, return value to shareholders. That's what makes this so effective. There's no villain you can easily point to. There's no dramatic moment of defeat that generates outrage or action. There's just a long series of rational decisions that collectively add up to dependency. Now, here's the part that should genuinely concern you. The revelation that changes how you see everything else we've discussed. China doesn't need America to fail. Read that again, because it's the opposite of what most people assume when they think about strategic competition. They imagine some zero-sum game where one side has to lose for the other to win, where the goal is to defeat the opponent, to make them weaker, to triumph over them in some clear, measurable way. But that's not the game being played here. China needs America to stay exactly the same. They need American companies to keep prioritizing quarterly earnings over long-term resilience. They need American policymakers to keep getting gridlocked in partisan battles instead of coordinating long-term industrial strategy. They need American consumers to keep choosing convenience and low prices over everything else, over resilience, over optionality, over strategic independence. Because America's system, left to its own devices, operating according to its own internal logic and incentives, will continue making all the decisions that increase dependency. Not because Americans are stupid, not because American business leaders are incompetent, not because American policymakers are corrupt, because the system is designed to optimize for short-term individual benefit And that optimization, when repeated millions of times across an entire economy by thousands of companies and millions of consumers all making rational local decisions, creates systemic vulnerability. It's an emergent property of the system itself. No conspiracy required, no coordinated attack necessary. Just patient positioning and a willingness to let American optimization do the work. Think about America's core structural weaknesses from a strategic perspective. Decision-making is slow because it requires consensus across multiple competing power centers. Corporate leaders answer to shareholders. Politicians answer to voters. Regulatory bodies answer to legal frameworks. Public opinion shapes what's politically possible. All of these forces have to align before major strategic changes can happen. That's the price of democracy and free markets, and most of the time it's a price absolutely worth paying because it prevents bad decisions and protects individual rights and creates space for innovation. But it also means that by the time America collectively recognizes a strategic problem, debates the solutions, builds political consensus, implements policy changes, and actually shifts behavior at scale, years have passed, sometimes decades. Years during which patient, centrally coordinated competitors can continue positioning themselves, continue occupying critical infrastructure, continue building the kind of leverage that takes decades to create, but only moments to exercise. America is divided in ways that make coordinated long-term action incredibly difficult. Different political parties disagree not just on solutions, but on basic facts and problem definitions. Different industries have conflicting interests and lobby for contradictory policies. Different regions of the country have different priorities based on their local economies. That diversity of perspective is often a tremendous strength because it prevents groupthink and surfaces problems that centralized systems miss. But it's also an exploitable weakness when facing a unified, coordinated strategy that can move faster and more consistently toward long-term objectives. American culture reacts to events, not to slow-moving systemic shifts. Something dramatic happens, a crisis, an attack, a clear visible threat, and everyone pays attention. Resources mobilize, decisions get made, action happens. But then the news cycle moves on and attention fades, and everything gradually goes back to normal. The most dangerous strategic threats don't announce themselves with dramatic events. They accumulate gradually, day by day, decision by decision, until suddenly they're irreversible. China studied this system deeply and learned something crucial. You don't need to defeat America. You just need to understand it well enough to let it defeat itself. You understand its rhythms, its pressure points, its decision-making timeframes. You move slower than those timeframes, so you're not perceived as an immediate threat. You position yourself in boring, unsexy parts of the system that don't attract attention or generate headlines. You become essential in ways that people don't notice until it's too late to replace you. And you wait, patiently, while American companies and policymakers make perfectly rational, short-term decisions that collectively increase your leverage. That's not warfare. That's not even competition in the traditional sense. It's something more like strategic patience exploiting systemic optimization. But the story doesn't end there, and in fact, the next phase is arguably more concerning than everything we've discussed so far. Because the next move won't target Washington. It won't target Wall Street or Silicon Valley or any of the institutional power centers that Americans think of when they think about national competition. It will target you, the American consumer. And when it does, it won't look like an attack. It won't feel threatening or dangerous or even particularly noteworthy. It will look like convenience. It will feel like progress. It will feel like getting exactly what you want, when you want it, at a price you're willing to pay, with less friction and more personalization than ever before. Think about how this plays out over the next 5 to 10 years. You'll have access to products and services that seem perfectly tailored to your individual preferences. You'll have apps that understand exactly what you want, before you consciously know you want it. You'll have entire ecosystems of connected devices and services that work seamlessly together, making your life easier and more efficient in dozens of small ways that add up to something significant. Your home will be smarter, your entertainment will be more personalized, your shopping will be more convenient, your daily routines will be more optimized, and slowly, without you ever making a conscious decision to give it up, without any single moment where you trade freedom for convenience, you'll lose the ability to choose something different. Not because anyone took it away from you, because the alternative stopped existing, because maintaining optionality became expensive and inconvenient, and the convenient path became so compelling that hardly anyone chose the alternatives, and eventually the alternatives withered away from lack of demand. Because by the time you realize that all your devices, all your services, all your daily routines, all your small conveniences run through systems you don't control, systems optimized for someone else's interests, systems where the priorities might not always align with yours, you'll be so deeply integrated into those systems that extracting yourself would mean giving up functionality you've come to depend on. Functionality that's now woven into how you work and communicate and entertain yourself and manage your home. This isn't science fiction. It's already happening in smaller markets around the world. Countries that adopted certain technology platforms or infrastructure systems because they were cheap and effective and arrived first, and now find themselves locked in, unable to switch without massive economic disruption and cost. The American market is different in scale, different in wealth, different in options. But the principle is exactly the same. Once convenience replaces control, once ease of use becomes more important than ownership of the underlying systems, once integration becomes so deep that extraction is painful, there's no easy way back. You can't uninvent the dependency. You can't rebuild decades of infrastructure in a few years. You can't recreate supplier networks and expertise and institutional knowledge that no longer exists because the market stopped rewarding it a decade ago. This is the real game being played, not a competition for dominance where one side wins and the other loses in some clear, measurable way, but a patient strategy to make dependency feel like progress, to make loss of control feel like gaining convenience, to make strategic vulnerability feel like economic efficiency. And the terrifying part isn't that it might work. The terrifying part is that it already is working, right now, and most people haven't noticed yet because they're watching the wrong things. They're watching the obvious conflicts, the trade negotiations and technology restrictions and political posturing, the things that make headlines and generate clicks and feel important. They're not watching the boring infrastructure, the logistics networks that move 90% of global trade, the payment systems that process trillions in transactions, the manufacturing capacity that produces everything from antibiotics to solar panels, the rare material supply chains that make modern electronics possible. All the unglamorous pieces of the system that actually make modern life function. Those pieces are shifting, slowly and systematically, and by the time the shift is visible enough for most people to notice, by the time it affects their daily life in ways they can't ignore, it will be too late to reverse course without accepting massive costs and disruptions that no democracy wants to impose on itself. So what does this mean for you personally? It means that over the next decade, you'll likely see gradual changes that each seem minor in isolation, but collectively represent something significant. You'll see fewer American-made alternatives in certain product categories, not because American companies can't make them, but because they stopped making them years ago, and restarting is prohibitively expensive. You'll see longer supply chains and more complex dependencies in products you use every day, more vulnerabilities to disruption, more points where problems in one part of the world cascade into shortages in your local store. You'll see prices that don't quite make sense based on traditional market forces, that seem disconnected from supply and demand, that reflect leverage and position more than cost and competition. You'll see companies making decisions that seem to prioritize access to certain markets over other concerns, over values they claim to hold, over interests that might have taken precedence in previous decades. None of these changes will be dramatic enough by themselves to spark widespread outrage or demand immediate action. Each one will be just small enough to accept, just understandable enough given the circumstances, just rational enough given the constraints. And that's exactly the point. The goal isn't to shock the system into response. It's to gradually reshape it in ways that become the new normal before anyone realizes they've lost the ability to choose a different path. Before anyone recognizes that what felt like a series of convenient choices was actually a systematic loss of leverage. That's what happens next. That's what's already happening. And the question isn't whether you'll be affected. The question is whether you'll notice before it's permanent.